Welcome, everyone. It's Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. I am really honored and very excited today to have Harry Dent Jr. on investing during crisis. Harry Dent Jr. is the author of 0 Hour, and I highly recommend going to harrydent.com for the free newsletter. He's been a big figure in the community. I've been reading his books for years. I highly recommend the newsletter. He's one of my favorites. Harry, welcome to the show.
Yeah, nice to be here, Angelo.
Thank you. It's really a pleasure. So let's get right to it. Dollar deflation over decades. I think people gravely underestimate that. I mean, I've thought about, and I know you have a little bit of a different perspective on, and you're going to be very big on historicals and doing the research, but dollar nominated, priced in gold, the stock market, I don't think has really done that great, even going back over different periods of time, 5 years, 10 years, 15 years, 20 years. And I've always wondered, but there's very little on it. Forget even just gold. How about silver and oil? Copper and lumber. I mean, who would be the winner of that? What I'm basically trying to say is I think a lot of the perception of gains in the markets relative to dollar nominated, I don't think they've been that great for most investors.
Well, I look at it differently. Commodities go on a 30-year cycle. I mean, that's the best cycle. I had that from day one back in the 70s when I was still a young punk, because it was an obvious cycle. And gold is part of that. And what we've had here is up until recently, we had a coincidence of a huge demographic cycle driving things like stocks and the broader economy, and this commodity cycle up with it. So gold has done very, very well. Gold has been a bubble. And I have to remind some of my gold bug friends like Peter Schiff that they're talking about bubble this, bubble that. I'm like, look at the bubble in gold that happened recently before it hit 2089. Okay, gold has done very well. In fact, gold bubbled more than stocks. So yes, if you compare it to gold, then yes, stocks would look so. But gold is not. I'm sorry, is not our money in exchange now. It used to be. It could be in the future. I think Bitcoin has a better shot at that. Not now. It's a baby and it's way overvalued. But so I don't measure that. I look at stocks compared to our standard of living and inflation. They've done very well. This has been the greatest boom in history. But hey, on the commodity side, I was bullish on commodities and gold too. Now the commodity cycle is down since 2008 or so, and gold and silver peaked on the late end of that. So actually, the commodity cycle was due for late 2009. Broader commodities peaked in early 2008, I think, mid 2008, and gold and silver peaked in 2011. So either side of that. That cycle's down. The stock cycle has been down by my projections demographically since late 2007. This is why I explained to people we've been living off of endless printed money ever since, and it hasn't caused inflation because we're just making up for the decline of the massive baby boom spending cycle, which is a predictable thing. People spend the most money at age 46, now 47, going on 48 for the millennials and stuff. So both of these have been down. So gold and stocks in the 2007 right boomed together. So yes, priced in gold, yeah, stock wouldn't have been. In fact, gold did better a lot of the time. But now that's going to diverge. And the 30-year commodity cycle, I always had pegged, and the tops are much more consistent than bottoms on the commodity cycle. But for about 2023, and the demographic cycle for stocks turns up again around 2023. So I think they're both going to boom together in the next boom after this crash that I think we're going to have, just to get rid of the bubbles and everything, but include gold bubble too. So we get rid of the bubbles. We come out of this. The U.S. is going to be pretty strong with the millennial generation, but Asia is going to dominate, and Asians love gold. I think gold's going to do better than most commodities, and better than most commodities in the next commodity cycle from about 2023 roughly to 2038 to 40. So there's going to be another big commodity and gold boom, but Asia is going to drive it. And Chinese and Indians are the biggest per capita buyers of gold. China's like kind of equal, but Indians are less wealthy. As Indians get more wealthy in the next boom, I think they're going to drive gold even stronger. So I'm very bullish on gold because of that. I'm not bullish on it as a safe haven because this is going to be a deflationary crash. Gold was the ultimate safe haven in the 70s, long recession when the last generation stopped spending. Gold, it was an inflationary crisis, and gold is the, I'll say Bitcoin is an inflation hedge. No, gold is the inflation hedge.
Okay, so I might have it, pardon my language, ass backwards. I know most people say that gold is an inflation hedge, but I have argued in the past, and probably not successfully, that I think gold may be more of a deflationary hedge. You feel differently. Give us more context.
Well, first of all, gold correlates closer to inflation than any other major investment class. And it's hard to say what it does in deflation because in the 30s is the only time we've had real deflation in modern history in the last century. And of course, they froze everything. They control the price of gold and they did all this, so it's hard to measure that. No, I say, and I use 2008 as the gauge, okay? We come into that downturn. That downturn started slow. Gold was trending up because they're seeing, they're going to print money, the economy's slowing. And then when Lehman Brothers went under, which now signals deep recession and deflation, gold crashed 33% in a matter of weeks. Gold did not prove, in my version, to be a deflation hedge. The dollar, the US dollar, every gold bug says gold's going to 5,000 in this crash and the dollar's going to zero. I say, no, the dollar is the safe haven and gold not crashing as much as other commodities, and it didn't then, and I won't this time. I say gold goes back to that $1,000 low in this crash, way better than most commodities and holds way better because it has that kind of golden quality, that security quality to it, but it's not a deflation hedge. I am crystal clear. Gold is not your deflation hedge. The US dollar and the highest, the Treasury bonds are what do the best, including, look at the last flash crash. Gold went up a little at first, same thing, down and then back up. Gold was one of the better places to be, but still went down. The US Treasury bonds and the US dollar were the safe haven in 2008 at the worst, and even in this little 5-week flash crash. So that's the way I look at it.
Okay, so
buy in the downturn.
You're predicting a significant crash that I think you might have moved the timeline from late April of this month. This is April of 2021. If you're
all you do is move this timeline because all they do is print more money. Doesn't matter. It will end, and it will end badly. Peter and I, even though we disagree on inflation versus outcome, we're crystal clear on this. You do not
June, Harry. Do you think June or
money out of thin air?
Is it going to be this summer?
No, I think, I tell you, at the latest, the end of this year, including Bitcoin, I predicted the recent crash in Bitcoin starting, but it could go up one more time. I think we're getting ready to peak in stocks here or soon. It could last, depending what they do, but we are in the late stages because what's happened, Angelo, is because of COVID, which I called the perfect trigger when it first hit. That was such a shock. They had to step up so big. You count all the monetary and fiscal stimulus and another 2.2 already promised. You're talking 55% of GDP in the last year and a half between monetary and fiscal stimulus. How do you come back from that? If that only gets us going for a little while. And by the way, the Chinese recovery went straight up and stalled because everything's so overstimulated. Their workforce growth is down, the first emerging country. Our workforce growth does not grow ever again, okay, any sustainable amount. I think we come out of this at first and then it stalls just like China's doing. And then all of a sudden stocks are expecting more and stocks go down and all this sort of stuff. And man, I tell you, after printing 55% of GDP, what do you do? 100%? They're going to do $20 trillion stimulus plan next time? I think the central banks have overplayed their hand, and this is where they fail. They're just going to fail.
Okay, so let's get, I think, an integral question for my members and my listeners, and they're going to have time on their side because some of them are super rich. It's family offices. What would you recommend? Do they simply hedge their stock positions? Do they liquidate? Do they accept the gain? And, we had Rickards on a couple of months ago, and he was basically 60% in cash and treasuries. I admit that left me scratching my head, and he has been wrong. That was about 3-4 months ago.
That would have been left me scratch. I debated him not too long ago, and I wouldn't have remembered him being in treasuries. Yes, I think that you can. I'm not like somebody just saying this is going to happen, be short. Okay, no, that's been very, very painful. What I look at in a period like now, in February, things were looking like potentially toppy. So, hey, you can put on some put options for 2-3%, hedge your stocks, don't sell them yet. Same thing here. We're coming into late April, the second half of April or May. I think this is, especially with the recent collapse of Bitcoin, which I predicted last week, if it broke 60, that it would break hard. Bitcoin has led stocks. Everybody thinks Bitcoin's a safe haven. Bitcoin is the worst, the least safe haven. It's like the dot-com stocks of the first tech bubble. They're coming in strong at the end. It's the beginning of something big down the road, but way, way overvalued. So Bitcoin is leading this, and Bitcoin keeps being weak. I think stocks are going to follow. So I think right now I'd be hedging stocks, and then if we do see strong weakness, the next crash, by the way, on a very nice megaphone pattern. You ever seen one of those, Angelo? It's the best pattern. It happens in long-term stock tops like 65, 68, and 72. And we've got this thing early 2018, and then every high is slightly higher, but each low is significantly lower. It shows the stock market has momentum and wants to go up, and people want to go up. Fundamentals keep bringing reality. The next low, I mean, this could happen in a couple of months on the S&P 2100 from 4,400 here recently. Okay, that's almost 50%. Okay, I think that could happen in the next couple of months. If we see that sort of crack, this thing is over. There'll be a rebound of stimulus plan, but we won't come back new highs, and this thing will keep going down in that line. So yes, this is a time to hedge, and if it starts to break sharply, I would then not hedge anymore. I just get out of stocks. The best place to be in the crisis, same thing in early 2020, same thing in 2008. 30-year Treasury bonds is my number one pick. You can be short stocks, unleveraged, if you want to take more risk, because you make money when stocks go down, and stocks are going to go down more than bonds. The high-quality bonds go up. Corporate bonds are going to go down. Most real estate is going to go down, except for apartments, and even maybe that a little bit. All stocks are going to go down. Some go down 50, some down 90. Everything goes down when a bubble of this magnitude, this global peak. And even more than 1929. And by the way, that was on a 90-year cycle. The biggest bubble cycles since the Industrial Revolution have been 90 years. A double technology cycle, I call it.
However, that then gives me dry powder coming out of a horrific bear is a bull market and the opportunity of buying on the low.
Absolutely. Well, first of all, you can be in cash. Cash will preserve your money when all these other financial assets are dropping. Okay? A 30-year Treasury bond, or even a 10-year to a lesser degree, will go up 20, 30, 40% because the risk-free rates go down as we get deflation, but the risky rates, corporate bonds and other things, go up because of default risk. So that's it. You have to be either AAA corporate bonds. I still like the 30-year Treasury bond, even at a 2.3% yield right now. You lock that in for 30 years, and we go to near zero, and of course negative in other countries. But I think that 30-year Treasury bond could go down to 0.5%. The 10-year zero or negative. You're going to have a 40, 50% gain on the safest, most liquid asset in the world. And yes, when all these financial assets go down, and I think gold to a lesser degree than other commodities and stocks, I'm seeing stocks going down 80, 90%. I'm seeing gold 40 to 50. I'm seeing commodities 60 to 70 because they've already been whacked. Real estate 30, 40, 50, more than last time. So think about your house, how much it fell last time. We'll add 20, 30% more down than that. Wow. And that's real estate. You're in these safe bonds or in cash, and all this stuff crashes. Now you buy 2 years from now, late 2022, 23 timeframe, and everything's going to go up from much more affordable levels. And gold would be my number one pick in the commodity sectors. There's some others cool ones, but for risk return, gold would be because Indians and Chinese love gold, and Asia is the future, particularly the India side. And the Indians spend about the same amount as Chinese on gold as a country, but they're much poorer. The Indians are going to get dramatically richer, and the Chinese aren't. in the next boom. So India is going to be the biggest factor for gold to buy in this downturn. So I do not see gold as the safe haven like Peter Schiff would see it. I do see it is perhaps the best overall commodity sector buy when things go down. And I do see gold only going down 50% roughly from its top, and other commodities 70, 80%. So gold's the best of the commodities. The US is the best house in the global neighborhood. So we come out of this the strongest in the developed world.
What do you think about uranium and rare earths?
I like that stuff because what you said, rare. So that sort of stuff, should do well. And that's what you do when the commodity crash bottomed. Now remember, commodities went down hard first. Okay, so they're already not as overvalued. Stocks keep going up. The money printing primarily goes into stocks and then real estate and bonds. It doesn't go as much into the commodity sector. So because they're not financial assets as much for most investors. So you look at the stuff that goes down the most and comes back in a recovery. And again, I think gold's going to have an added edge it didn't have before in this next boom. Again, I cannot understate India. India is the next China. I even get Indian economists arguing that, say it's not possible. Baloney. I bet my life on that. I've only got about 20 more years, but I bet it any. India is going to be the biggest factor driving. Indians love gold and wear it in places we don't even think about.
I don't think everyone's ever said that on my podcast, but I think I know what you're talking about. Every person I have on, except for Michael Saylor at MicroStrategies, disagrees with me on this. So I want you to cut me up on it. It's okay. My belief for the super rich, and again, I did qualify that, living in a New York, a London, buying residences in Malibu and the Hamptons, wanting to buy more stocks, owning football teams, buying art. Their true inflation, the government's telling them 2 or 3%. That's complete baloney.
Yeah, they have way higher inflation.
15 or 20%. You agree with me, Harry? No one ever does.
Oh, absolutely. I mean, you have to realize in a bubble, particularly in a bubble boom, we have not seen a broad bubble boom since the Roaring '20s. That's how long. Nobody was alive to see it. Okay, that's how long ago. In a bubble boom, financial assets are the biggest beneficiaries, including real estate. Who owns the most? See, the top 20% own 90% of the financial assets, and the top 1% own 50% of them. They get the biggest gains from this. And then here's my problem. See, people say, well, these people won't stop spending money. No, these people own the bubble more than anybody. This bubble crashes, it's going to hit the rich way more than Homer Simpson, who may have a little bit of stocks in their portfolio and own a little not so overvalued real estate in the middle of the country down the street from Warren Buffett in Omaha or someplace. If it doesn't bubble, it doesn't burst. So the average person is not as exposed as bubble. It is the rich. Everybody says, oh no, the rich will do that, and the rich won't sell, and the rich will buy. No, the rich are going to lose their ass in all these expensive places you just mentioned. Manhattan real estate is going to fall way more than Omaha or Dallas or.
But is it going to bounce back?
Huh?
Is it going to bounce back more in a couple of years?
It will, but you have to realize the confluence of things. I have a title in a lot of my book chapters of real estate will never be the same. And here's why. Any demographic sector I look like, automobiles, clothes, you name it, potato chips even. I know when they peak, I can project with the demographic and a new generation, when they're going to grow, when they're going to peak, and things peak at different times. And right now, my favorite sector in the U.S. is nursing homes. The last thing baby boomers doing assisted living. That's going to be a boom, and it's just starting. People think it's over. It's just starting. Okay. So here's what's different about real estate. Okay. Real estate, unlike all these other consumer, lasts damn near forever, right? So when people die, what happens when you die? You are a seller, whether you hand it to your kids and they don't have to buy a home because you gave them one, or you put it on the market, supply, okay? I have to take real estate's the one sector, like workforce growth, where I have to take the peak spending, then I have to subtract from that buyers who are sellers. So I have to have net real estate demand. Real estate demand in the United States has already peaked forever. China, forever. Urbanization is a little bit of a trick there, but in the developed world, it's peaked forever. We are never going to see a boom in real estate like the baby boom caused. Okay? Never. So real estate will go down dramatically. It will come back, and it'll come back always strongest in the high end. It will not come back to these levels. I do not think you'll see real estate in most expensive areas in the US or Europe or Japan, major developed countries, this high ever again in anybody's lifetime listening to this show. That's my projection. That's what I'm predicting. The demographic says it, and real estate, people know real estate. Japan's real estate. Here's what got me on this, Angelo. A little slap in the face for me. I couldn't explain what Japan. I predicted Japan crash, for crying out loud. Real estate went down 60-some%, and then when the millennials came along, it didn't even bounce. I'm like, what? It took me 2 to 3 years. What? Hey, these millennials are real. They're buying houses. But I didn't realize the old generation, the baby boomers there, were still dying in increasing numbers, throwing more supply on the demand. They were countering their younger generation's trend because the baby boom generation was larger than the generation to follow. This has never happened in history, Angelo, and the developed world just continues this way. And China is the first emerging country that will come out of this downturn, not everybody else for a long time, especially on it, with falling workforce growth. Their workforce peaked in 2011 forever. Well, workforce growth, it pretty much correlates with real estate buying. Oh, real estate's not going to come back as strong in the developed countries and in China. If you want to make money in real estate, invest in the emerging world, and particularly in India.
And I mean,
lots in India, and you will never go wrong for the rest of your life. No matter how
so, I mean, COVID has changed dynamics. I'm in the New York area. People are moving to Florida for more ease on COVID, business regulation, much more business friendly, warmer weather, no state taxes. Do you think that COVID has completely changed the landscape of big city, New York, Chicago, LA, office real estate forever? Is remote work to some degree, it's forever changed real estate, and that impacts where people live?
Office, all that did was accelerate what information technology has already done. People have always been able. I've been working out of my home since 1989. Saving. I don't have to dress up every day. I walk around in my bathrobe half the day. I don't have to commute to work. How much time I save?
And you're happier.
I'm comfortable, and I got my own office the way I want it. Not a bunch of other annoying people down the hall, to have to talk to and be nice to and stuff. It's like this is already happening. COVID accelerated that. So that's a trend. Commercial real estate is dead, okay? Long-term, workforce peaking, so that's number one. With shrinking workforce, how is commercial real estate, because that's what it's about, including malls when people spend the most, the workforce correlates with that. And now more and more people are going to be able to work from home part-time or full-time. I think most people will split half and half. I'll go in the office 2 or 3 days a week. I'll work at home 2 or 3 days a week. And get the best of both worlds. Socialize some, certain things you can do in the office, but a lot of stuff you can do home. But whatever, we're not going to need as much commercial real estate. Now, residential is different. Anybody that's got stronger millennial generation, the US millennials only bring us back. We will not need more new homes in this country ever again, unless you're in some growth city in Albuquerque. Okay? We'll come back because we have a strong millennial. Japan never had as strong a millennial generation. Most of Europe doesn't have as strong a millennial generation. Also, so the US will have a stronger real estate comeback than most of Europe, except for Northern. And then Japan will never come back. And then most of the growth is going to be in the developed world. And I lecture a lot in Australia. Australia and New Zealand, but particularly Australia, has the best demographics in the developed world. They're going to come out of this strong. For all types of reasons, also because they're on the right next to Asia, which is the next big boom. China, Japan, the tiger drove this boom. East Asia, China, South Korea, Japan, Taiwan, they drove this boom stronger than anybody. All of those countries have worse demographics than Europe and the US going forward. Worse, nobody would have thought. They got rich quick, so they stopped having babies quicker than anybody because wealth causes less birth. You want lifestyle over having a bunch of kids that suck up all your money or whatever happens. So urban wealthy people have the fewest kids. So when this thing shifts, the place to make money is places like Australia and India and the emerging world, or in the right sectors. If I could buy up real estate that I could convert, like failing maybe retail centers and stuff, and convert it into nursing homes, you can make a fortune doing that. Nobody's going to see the baby boomers coming to nursing homes because that peaks at age 84. Everybody thinks, oh, baby boomers have already retired. Oh, they're already peaking in travel. Yeah, they're just starting to move into nursing.
Yeah, those are no.
For 25 years, there will never be enough nursing homes. So the right sectors of real estate, but the developed world is pretty much done in commercial and even most residential. There's no, people spend the most money residential on real estate by age 42 in the United States. It's done. The millennials will at best come back to where the baby boomers took us in this great real estate boom, and no higher. And we will never see real estate prices bubble like in this time, because this was a bubble era driven by bubble factors. The next global boom will not be bubbly like this any more than the 50s. 50s and 60s was a great boom. It wasn't bubbly in stocks. It wasn't bubbly in real estate.
And I have a lot of questions for Harry, but heads up to our audience is he is going to be limited on time. So it's not going to be the normal 90 minutes to 2 hours. We got about 50 minutes to work in. So I am going to skip ahead a little bit. In the early days, and you're a great historian, in the early days of the public equity markets, the stock market, I could make the argument, does it feel a little bit like the early stages now, 12 or 13 years into the crypto market? There's lots of ups and downs. There's not a lot of historical. Is history going to repeat itself? And the inefficiencies of the crypto market could be where the asymmetrical bets in the next 1 to 10 years could be.
Yeah. Absolutely. I don't see anything more misunderstood than Bitcoin. People say it's the digital gold. It could be one day, okay? It could be, if it gets up to about $500,000 to a million a coin, it could have the stature of gold in the old world and be a kind of a standard for the new digital currencies, which may come outside of governments, which would be wonderful. Okay? But Bitcoin is not that today. What I compare Bitcoin and cryptocurrencies to, and this is recent, to the dot-com internet bubble in the late 90s and the crash in the early.
Well, Harry, you're on mute on Zoom. Somehow it muted.
Okay. Now am I back on? Okay.
You're good.
So we're in the second tech bubble. The first tech bubble, the dot-coms, companies like Amazon, the dot-com retailers only came in. I think Amazon went public in 97, went from $6 up to 136 in the bubble, and then crashed back to 6. Still the leader in that sector, okay?
Right.
Well, we had the internet, actually the retail, the dot-com. I compared that to Bitcoin crypto. Their early days were the late 90s. They crashed big time in the first, and then now they dominate the world. Amazon dominates the world. All those companies that survived, and most of them went under, of course. And all the, a lot of Webpan, tons of them went under. So that's what this is an early stage industry. You're right. This is the first several years of an early stage industry. I call the crypto blockchain sector, and blockchain is a better way to define it. Bitcoin is just a potential standard. Bitcoin doesn't do much, by the way, except for help drug dealers transfer money to South America, okay? But it will, okay? This is early stage, and I think it's the internet 2.0. It's the second stage of internet. The first stage of the internet was about information, email information. This is about financial assets and money. This is the internet of money. It needs way better security. Blockchain solved those problems eventually. If Bitcoin can become a standard for this industry instead of government currencies and stuff and replace that, I'm telling you, this is going to be the best thing that ever happened. So I see Bitcoin as the potential standard years from now for the new digital money system, which hopefully should transcend governments.
But I got a question on that. Do you think central bank digital currencies, centralized money, and the government using programming dollars will not make Bitcoin become potentially what it could be?
No, I think what happens, what the Bitcoin people should be, they should be following my ass, okay? I hate to say it. I think this financial asset, I'm thinking the biggest breakdown in the financial asset system and monetary systems in the world since 1929 to 32, okay? If that happens, You think anybody's going to say, oh, well, governments will be fine if they just go digital? No, governments, central banks are going to be, listen to this, discredited more than any time in all of modern history, never to be seen again. Okay. You would not want to be Jerome Powell or what's her name, Tweety Bird,
Janet Yellen.
Janet Yellen. These people have said all we got to do is print money and everything will be fine. No, they're going to prove that governments should not be in the standard for this. And the U.S. dollar, even though it's the best house in a bad neighborhood, and it is, and we'll prove that. Mark my words, it'll go up in this crisis. Am I buying the dollar after that? No. I'm going to be buying Asian currencies that exist. This has the potential to have a global system that transcends the currencies of countries. That's what needs to happen out of this. And that we are so far away. Anybody thinking that's the truth today, Bitcoin is a baby, just like Amazon was a baby. When it 36 and crashed 95%. I'm expecting Bitcoin to crash 95%, then I would buy the hell out of it.
Do you think in 5 years, or it's going to be more 10 years or longer, will the Bitcoin market cap surpass gold?
Oh yeah, no, it'll be maybe 5 to 10 years from now. It has to go down, has to come back strongly, become the next big thing like the internet stocks did. Again, I got a lot of things. You should remind me to send you this chart. I track the internet stock versus Amazon as the leader, and now I track the block, the blockchain and Bitcoin is the leader. Okay, he's doing the same thing. Baby bubble in the early stages gets way overvalued because what happens? The new great thing in its infancy happens when the last great thing, i.e. those internet stocks now that were babies in the late 90s, when they're peaking at high valuations, everybody says this is a nice big thing. So they value Bitcoin like it's already there. It's not there. It is a baby. So anybody wants to value it this. So when it proves itself in the next boom, yes, its value will go up. It will surpass the value of gold, I'm predicting, in the next boom.
And how about
it become a global standard for a digital system, which hopefully is not dominated by any one country. Countries have to feed off the Bitcoin standard and not the US dollar or some fiat currency standard.
This question is kind of related.
This failed. They're going to prove in this crisis that governments don't know how to manage money. So why would you bet on them? We need an independent standard. And that's what Bitcoin and crypto and blockchain companies can help create. That's a big deal. It's going to take time. Now, I basically correlate the whole blockchain movement with the internet bubble on about an 18 to 20 year lag. So I would say Bitcoin, this blockchain bubble, which is about to peak and crash, remember what I said, 95%, maybe a little less, but that's what I bet on from Pat. It'll become the next big thing and mature like the internet stocks have today by about 2036, 37, when the next global boom is peaking.
And what's the market cap, do you think, of all oil in the ground? Is it around 100 trillion?
I don't know. It's a lot. They keep saying we're running out, and of course you don't. There's always more. You just have to dig a little deeper or do things more efficiently. So that I don't know, but I know I've never believe the Club of Rome and thinking, oh, we're going to run out of oil. The reason oil gets replaced is because it's a polluter. If you can't find a clean option for oil that's affordable, then other things will replace that eventually. And they already are. So I don't see oil is going on forever, but I don't see it dying in the next boom either, because guess who's still going to use more oil? The emerging world is going to be Angelo, literally, demographically, you look at what I'm looking at, all the growth in the world, except for Australia, is going to be in the emerging world demographically. The developed world has peaked, and China is the first of many to come emerging countries to peak with it. China has peaked in workforce growth already and will never grow except for a little bit more urbanization. So it's the rest of the emerging world is going to be all the growth. Those people are not going to switch to new technologies and new fuels as fast as the developed world is. So oil's not going to die, but it's never going to be as important as it was in the 70s.
Let me ask some crazy questions. You'll get a chuckle, but it may get an interesting comment. Why do we pay taxes at all? if the government can simply print money, effectively MMT, and that relates a little bit to inflation and the velocity of money.
Okay. Yeah, that's an interesting new theory, and it makes sense until you think about it a little farther. Yes, why should it costs money to collect taxes, and people don't like to pay them. You got to beat it out of them and stuff. Okay, just print the money you need to run your government, get the budgets approved, and have some hopefully standards or controls on it, which is scary because I wouldn't be. And then what will happen? Inflation will be the cost, and people will pay inflation. And rich people do pay higher inflation, as we were talking about earlier. And every day, rich goods always go up faster because they're more scarce, and rich people make more money and chase them, especially in a bubble like this. Here's the problem with it. Inflation, just like booms and bust, booms are when new technologies and new products and new generations grow together. And bust are when you clear out and shake out the bad stuff and prepare for the next generation to grow again with new stuff, okay? Booms and busts are necessary. Economists would like to have a 3% growth economy with 1% to 2% inflation that never has a recession. That tells me right there, they understand nothing about thinking, nothing if they think that. Booms and busts are an important dynamic, play of opposite. So is inflation, deflation. If you have this modern monetary approach, oh, the government raises money and creates the cost as inflation, well, then you have nonstop inflation. The greatest innovations happen when inflation is high or deflation is high and when the economy's down. That's when the greatest innovation, if you had this 3% forever growth with 1 or 2% inflation, innovation would die and we would go back to being monkeys, okay, living in caves. Okay? That's what would happen. Just being realistic here. So that's the thing. We need the inflation. Inflation encourages practical innovations because it says we're running out of supply and we need it now. Deflation encourages the long-term things like jet engines, or things that just big long-term things come in the deflationary periods, and things like microcomputers and software come in the inflation state. We need inflation and deflation, and so we can make it more moderate and make it more productive. But if your goal as an economist or as a country planner is to have an endless growth economy and no recessions, no inflation or deflation, you will kill the economy. And that's precisely what I say central bank has done. They have killed the free market capitalism and democratic system. Democracy is just a balance against the extreme successes of free market capitalism, which always rewards the 1% and 20% more than everybody else, okay? Democracy balances that. They've killed free market capitalism by taking over money and setting financial prices so that the financial markets can't drive these natural cycles of inflation, deflation, boom, and bust. If we'd have just let this recession go on, mark my words on this, another year and a half, like the Great Depression, 30 to 32, we wouldn't have this problem now. We would have knocked out all the zombie companies and all the excessive, unproductive debt. We would have cleaned out and been able to grow again. We're having to constantly print money because we never did what we should have done and never let that recession. We never let natural forces do their work. I hate economists. I would fire every damn one of them. Okay.
You know who said that on my podcast 5 months ago? Who's not a fan of Mark Faber? He said the exact same thing. He said something like he wouldn't hire them to wash his dishes or something like that.
Right, they're all, I always say academics never had sex or run a business. That's my description. Have you ever met one otherwise? What's his name? Greenspan. He's the only one that looked like he at least had sex. He certainly didn't run a business. He at least looked like he might have had sex.
Luckily, we're not a G-rated show, so that's fine, Harry. Keep it coming. What popped in my mind when you're talking, I'm probably not going to phrase it properly, but you'll do it for me. Banks create money, not the Fed, because until the money's lent out, it's not in the system with velocity.
Exactly. The Fed creates the monetary base, which is minor. The banks inflate that by making loans at typically, 10, 20% ratios, okay? Yeah. They're the ones, you're right. If banks are not lending and businesses and consumers are not borrowing to buy houses and build factories, the money supply doesn't go. The money supply has not grown that much. All this money printing, the money base has gone up gargantuanly, and money M2 do like nothing ever happened. It's not going into the economy, it's going into financial assets. The bubble from money printing did not go into M2 or GDP, it went into financial assets. So the big threat today, what happens when $525 trillion, and that's not 6.5 times GDP again, burst? We're going to see the biggest loss of wealth, which is going to affect who? Homer Simpson or rich people we're talking about in all these rich real estate places. It's going to hit the rich. I am here, Angelo, not to save Homer Simpson. Okay, I'm here to save poor rich people from losing all their wealth they built up in the last 30 years. You're the ones going to lose it. I'm just telling you. Homer Simpson doesn't have much to lose except for their job, and then they'll get jobs again down the line. Rich people could, I always say, remember Ted Turner, I always say, crying on CNN, his own entrepreneurial creation, crying on CNN, I lost 90% of my wealth, and say, Ted, still got $1 billion. No, he lost 90%. That hurts no matter what. You know the difference between 10 billion and 1 billion? Jane Fonda, okay? You'll get Jane Fonda if you're just a billionaire.
You're in rare form today, Harry. This is great.
I'm just saying, this is the truth. It's relative, but I'm warning people. Everybody thinks that the rich are the ones going to lose in this financial crisis. And I tell you, I talked to a lot of rich. They don't think real estate can go down in Manhattan ever, or San Francisco, or LA, or whatever. And I'm like, well, what about Tokyo? It went down and never came back. Have you looked at Tokyo? It used to be one of the richest, most highly valued billionaires everywhere. It never came back. People are asleep in this bubble. It's the rich people I have to warn.
Now,
Homer Simpson will survive because they don't get hit that hard. They lose their job for a year or two, and then they don't even have money in stocks, most of them.
Given the limited amount of time we have, we'll maybe go rapid fire on my final four. Let me know when you maybe have 1 minute left. Minimum wage. So raising the minimum wage, I think, is going to increase consumer inflation. Businesses won't absorb that cost. They'll raise their price of goods. What do you think? Am I wrong?
Yeah, I mean, that's what typically happens. Now, in my scenario, where we have a big shakeout in the economy and it slows down, businesses are going to be cutting wages, cutting costs, shedding offices and real estate at bargain prices. And consumers are going to be cutting back spending. So this becomes kind of mute in the scenario until we bottom out, erase this financial bubble, erase this debt bubble, and which is basically weighing down any future growth. All this stuff, financial assets high, borrowing against the future, mortgages the future. We have mortgaged the future more than any time in history, especially in the developed world. We have to clean this out before we go. Now, in a normal economy, yes, raising wages is only minimum wage and not letting the market decide whether some people are worth more or less. I like having some sort of minimum wage, but when you start making it $20, $30, that keeps people in bad jobs and overpaid and works against long-term progress. I don't like messing with the economy too much. You need rules for fair play, right, but you don't dictate prices or wages and stuff like that. If you do that, you're hampering the free market capitalist system. And again, I remind people, world wealth in the developed world has gone up 10 times just in the last little over a century because of free market capitalism, which only started in the late 1700s with Adam Smith and took off in the late 1800s. You're killing the golden goose by thinking, oh, well, now this succeeded, well, why don't we do this and do that and do this? No, you tinker with this system beyond fair rules for good competition, you're going to kill it. And they have already killed it with this monetary tinkering.
Now, Harry, could I make the argument on real estate that one that may be an interesting play, we need to eat farmland, US farmland. And it leads me to the question, not that I'm a conspiracy theorist, well, maybe a little bit, why is Bill Gates buying so much farmland?
Because I think he can see the world's overvalued. I tell you, I get this guy, I lecture in Australia the most outside of US. And the people there like me more than in the US. So give me a break for being bearish. Because they know I've been bullish so long. Farmland, it's the cheapest real estate, right? So it's less overvalued. No, not really. Farmland has gone up the last chart I showed in Australia, farmland's gone up 7-9 times. It's a bubble. Now, if I had a choice of buying a downtown office building or real estate in Iowa, I buy the real estate. I'm sorry, farmland. I buy the farmland. But farmland has been in a bubble. Everything bubbles when there's too much money chasing financial assets, because people realize this and they say, well, farmland. So farmland is just cheap compared to suburban land, which is cheap compared to urban downtown land. They're all bubble. Okay?
But in terms of the government, in 1988, they created the President's Working Group on Financial Markets, the Plunge Protection Team. I guess they came out in full force back last March when the markets dropped. Could I say they're artificially inflating it? They're quote unquote printing money, although technically digital money, really more than literally printing.
Yeah, all this printing is just to stop the economy from slowing. It stop deflation. Because once there's deflation, profits go down in businesses, that causes layoffs, and they stop buying commodities and inputs, and the whole thing deflates, okay? All of this printing money is to keep the economy growing just a little bit, but it's mainly to stop deflation. Ben Bernanke was the one economist, and he was the one in charge when this whole bubble crash and stuff first hit. He studied, he knew that deflation, if you look at the worst downturns in history, they're not inflationary crises like the 70s, they're deflationary crises like the early 30s, okay? Yeah. So deflation, the central banks are scared to death of deflation, and that's why they're printing money, and the money is not going into the economy. The only thing the money being printed up until the fiscal stimulus recently, so take that out, but all the money printing since 2008 has gone into financial assets, and those financial assets make the top 1 to 20% feel substantially wealthier, and they spend more. That's all that's happened. Homer Simpson's not doing much better than they did back then. And now, if this financial asset bubble bursts, then the only people, and in fact, here's how I explain our mediocre 1.5 to 2% growth in the last 12 years. It's 4% on the wealthy side and 0 for Homer Simpson. It's an average of those two. The top 20% control 50% of the spending, so they're not 20% of the economy. And the top 1% control 40% of the spending. And so you see the play. So the rich get richer. They're doing better. They're spending more. You ask most everyday people out in Omaha, they haven't seen the economy improve since the 1970s. Their standard of living hasn't gone up much, and they're not spending much more adjusted for inflation. So that's another, everybody talks about income inequality. I have a solution for that, Angelo. Let the financial asset bubble burst. That will shift this overnight. Yeah. Homer Simpson will get nicked and cut. The rich will get stabbed in the heart. That's why I'm warning the rich. I'm not spending time talking to Homer Simpson because they don't know me. I'm spending time talking to rich people because you're the ones going to lose all the wealth you built up in the greatest boom in history if you don't wake up and realize we're in the greatest bubble. In bubbles, you can keep them going, but every bubble in history is burst. And when they burst, there is no soft landing in history. If this will be, it'll be the first time. So I'm not telling people to bet on that. No soft landings for any bubble of any time, all of history. So don't bet on it. And if you the wealthy people are going to lose the most here, by far.
The FANGs plus Microsoft and Tesla. These are dominant companies, globally dominant, some of them like Amazon, Google. I mean, who's going to supplant them?
Apple,
maybe the government antitrust. I would like your opinion. I'm going to briefly give mine. I think the one that's still going to be standing in a top spot in 5 or 10 years, and they've proven it over 20 years, is Microsoft. Part of it is what they're doing a little secretly in the blockchain. Which one's going to be the first to fall off there? I think it's going to be Netflix. I won't bore my audience with the main reason. It relates to the metaverse and deep look into digital assets and how that consumer is changing. Who do you think will be standing and strong and powerful in 5 or 10 years, and who could be the first one to fall?
Well, this is like the late 20s. It was the RCAs and General Motors and Westinghouse and Ford and stuff. It was the new maturing leaders of the day. So this is the maturing of that internet bubble that was a baby bubble back in the late 90s, okay? So these companies are going to fall hard. They're going to go down 80, 90%. And some of them are not going to come down. So see that the internet bubble is peaking over a 20-year cycle and the blockchain bubble is emerging. So what you said is the most, and I don't know yet. I have to see what companies survive and what they do. It is the companies that move most aggressively in whatever they're doing in the internet side into blockchain and into the financial sector. So that's where blockchain makes a difference. I mean, Email is email. Blockchain's not going to make email a lot better. Financial stuff is massive. I have to, my credit cards get replaced every 3 to 6 months, no matter how careful I get. There's a problem here. So they come, like you say, Microsoft, if their secret is they're moving the fastest into the blockchain area, that's who I would bet on. None of these companies are going to die, but they have matured in this cycle, and they are going to have to get in the new sectors if they're going to ever grow like they have again. And most of them will have seen their best days. They won't die, they'll come back, but they're not going to be the leaders they were. So you have to look for the ones first that survived the best, and then are positioned in the sectors that start to grow. Blockchain is going to be the next big thing. It's Internet 2.0.
No doubt about it. Two final questions. I promise to make them quick. Do you have an opinion on Doge?
I don't. I'm just not that familiar with it. It looks. I saw something the other day. It's like it's correlating with something bad. It seemed like it's a nothing burger, but I cannot comment on that because I don't understand it.
And my last, it's going to be a comment. It's going to be out of left field. You may not have an opinion. That's fine. A single family office, and yes, that's what he is. Bill Huang, and I always mess up the goalpost, whatever. You all know what it means. That happened a month ago. So my opinion came from immigrants worth nothing, built up an incredible career, 200 million of his own capital, took that into his family office. And you would know this, Harry, to turn 200 million into 30 billion, that's 150 times multiple. And this dude is not doing it in penny stocks. It's actually amazing what he did to have a net worth greater than Ray Dalio and Steve Cohen without taking in outside capital. This is the modern day Jesse Livermore. Now, I might have lost 90% of my audience on that comment. Look it up, do your history, do your research. Risk management, terrible. Now, we don't know his personal guarantees. If he's not overly personally guaranteed, pardon that bad English, he still may be worth billions or hundreds of millions. We really don't know. So I'm not saying that he's a great investor or risk management person. No. But his trading history in today's markets, as far as we know, not breaking the law with what he did with swaps. Banks are greedy. They were getting $100 million a year from this guy, and they loved it. I think he's getting vilified when somewhat it's unfair from what I know so far.
Well, again, though, if I look at somebody like that, if he really has a trader mentality, which sounds like he does, he should be knowing things are over. He should be playing the short side. Jesse Livermore did short the stock market in 29, went bankrupt doing it 6 months early. Yep. And then after he went bankrupt, he raised another round of money and became a billionaire in today's term because he did end up shorting it. He had the guts to short it a second time and somehow raised money after he failed. So if this guy doesn't get out of the bubble that he made money off, then he's going to see, like Ted Turner, he's going to see 90% of his wealth disappear too. If he's smart enough to get out of the risky sectors and to start to play the downside, he could magnify his wealth even more. That the number one thing I remind people of, normal bull markets and bear, or especially bubbles, down markets go twice as fast as up markets. So a trader type mentality loves corrections and downturns because they can make more money faster if you see it coming. So a bear market to somebody sophisticated, if this guy's as sophisticated as it looks, that he really made money fairly with high leverage, of course, in the bull market, and he plays that, the down market, God knows what he can do.
Yeah, I don't know if he's going to have that opportunity if he's been wiped out, but we don't really know his full picture.
That's right. It sounds like he already may have overdone. So, but right. That's the trick. He'd have to continue to play like a trader. If he doesn't switch directions, or if he already got wiped out too much, then he's just not going to have the capital to do it.
Oh, but if he even has 50 to 100 million, I'd like to see the magic that he could do. But we may never find out because it is private as far as we know so far, which again, I'm a big believer in the government not necessarily putting their nose into private individuals that are investing, that have built great companies, have massive philanthropic initiatives. But don't get me started on that. Your team is going to get mad because I did take you over time. Again, really fortunate to have Harry Dent Jr. on, author of 0 Hour. Highly recommend you go to harrydent.com, sign up for the free newsletter. I do have to give about a 1-minute close, Harry, but if you're super tight on time, feel free to exit. It's been great to have you on, and I look very much forward to the next time.
Sure. Yeah, I enjoyed it, Angelo.
Thank you, Harry. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles podcast, and I'm the founder and CEO at Family Office Association. Really enjoyed having Harry on. Been very fortunate to have many prominent people in the world of finance, economists, even though we just killed them a little bit, cryptocurrencies and all that. I'm really honored to lead these interviews, and I feel I learned so much. And thank you for my audience support. Feel free to keep negative and positive comments come in. I have followed some of the negative, and I think some of it has been good criticism. So thank you. Send in questions, be supportive. We all appreciate it. And learn more about Family Office Association. Very simply, go to familyofficeassociation.com, maybe look into becoming a member. Hopefully we provide enough value. You're just getting a small snippet of it here, likely via YouTube and all that. We're very active on social media. We're Family Office on YouTube, Family Office Association on Instagram. Go and follow us, learn more. Thank you again, all of you, for your support, and certainly keep the recommendations of potential guests coming too, especially if you know their contact info or their DM on Twitter, whatever. I'd love to reach out and interview amazing people. Whether I agree with them or not, I just want to make it an interesting discussion. Everyone, thank you so much for your support. Have a great day.